Hello students and welcome back to bankexamstudy.com. My name is Ramandeep Singh and today I'm going to do a live session on SEBI grade A, right? So today I'm going to teach derivatives. I'm going to do very important questions from the derivatives chapter. You are going to find these kind of questions in your exams, very important in the finance portion. Let's start the session. Before starting the session, let me tell you that I'm doing the SEBI Graded 2020 course in which I'm providing video classes, notes, test series, downloadable notes. And last year we got, in 2018, we got 9 final selections out of the 47 students, right? So let's start the session without wasting our times. So if you expect the British pound to appreciate, if you expect the British pound, first of all, you should know this thing, okay? The currency put option and currency call option, right? So a put option, for example, you, according to your judgment, the Reliance Industries share is going to fall. According to you, this share is going to price is going to fall. What you should do? The price is going to fall and you want to take advantage of the fall. So what you can do? You can borrow the shares from your broker and sell it on a future date. Okay, are you getting it? And so a put option is right to sell. It is right to sell at a future date. And call option, it is right to buy. It is right to buy at a predetermined future date. Okay, currency put option, currency call option, right? It is a right, not an obligation. So the first question, if you expect the British pound to appreciate, according to you it is gonna appreciate, you would speculate by dash call option or dash the put option. So according to you, the British pound, the value of British pound, what you are gonna do? You are gonna buy the call options. You're gonna buy the call options and you're gonna sell the put options. You're gonna buy the call option as explained. According to you, the price is gonna rise. So you're gonna buy the call option. What is called right to buy? Call option, it's right to buy. Okay, so the price is gonna rise. So you're gonna buy the call option and sell the put options. Okay, so our next question, the purchase of a currency put option would be appropriate for which of the following? The purchase of a currency put option would be appropriate for which of the following? So if you know the answer, give me your correct answer in the super chat. I'm reading your answers. Okay, let me just open the super chat and let me just check if anybody is having answer. This particular lecture is also very important for RBI grade B, for IBPS, RRB, GBO. So a purchase of a currency put option would be appropriate for which of the following? Investor who expect to buy a foreign bond in 1 month. Corporate who expect to buy foreign currency to finance foreign subsidiaries. Corporation who expect to collect foreign account receivable. So purchase of currency put option would be appropriate for what? So what you are doing is you are buying a right to sell. You are buying a right to sell the foreign currency. Which of the following is correct? So the corporation who expect to buy foreign currency. See students, in the future you need the currency. Okay, so you want to hedge your risk. You want to hedge or you want to cover your risk. You don't want to take any risk. You are a corporation and you don't want any risk. So in the future you are consolidating your position. Okay, the purchase of a currency put option. You are purchasing a put option right now. You are purchasing a put option right now. Okay, corporation who expect to buy the foreign currency to finance the foreign subsidiaries. So what you're gonna do is you're gonna buy a foreign currency by selling your home currency. So that is why you're selling your local currency. So you want to sell your local currency in future. So you are actually purchasing a put option. So B is the correct answer, because you want to sell your currency in the future. Question number 4, a very easy question. A UK corporation has purchased a currency call option to hedge $70,000, 70,000 US dollars, 70,000 US dollars payable. The premium. See students, if you are buying or selling options, okay, if you are trying to hedge your position, the person who is giving you those options, he would charge some fee for that. That is called the premium. So the corporation has purchased the currency call option. Purchased a currency call option, ठीक है, to hedge a $70,000 payable in the future. The premium is 0.015 cent and the exercise price of the option is 0.54 pounds if the spot rate is 0.59. If the spot rate is 5.59. See students, you already hedged your position. You got a right. You got a right to sell. You got a right to, you already have a call option, right? You have a right to buy a dollar for just 54 pence or cent. Okay. $1, you can buy $1 for 54 cents, while the market price at the time of exercising that particular option is 59 cents. Okay, why would you buy for 59 cents? Okay, there is no point of buying the 55.9 cent. So what you are going to do is you are paying the 54 cent plus 0.015 cent for the premium. So 37,800 plus 1,050. 38,850 is the correct answer. 38,850 is the correct answer. Very, very easy. Okay. Very, very easy. So somebody is asking the question. Corporation who expect to collect. See students, I guess both are, there is a doubt between two options. Okay. So both can be, I guess, correct. Corporation who expect to, collect foreign account and receivable. See, both are correct according to me. I mean, I also had a doubt, but according to me, both are correct. Both B and C are correct. So question number 5, European currency option can be exercised dash. American currency option can be exercised dash. If you have the correct answer, let me know. So European currency option can be exercised at any point of time at the expiry, but the American option can be it can be exercised any time up to the expiry date. Okay. When currency options are not standardized and traded over the counter, then what kind of risk are there? There is dash liquidity, and there is a what sort of bid ask spread would be there. There will be, if the currency options are not standardized, right, then it would be there would be less liquidity and wider bid ask spread. Okay, because see students, if somebody wants to buy want to sell 100,000 needs $100,000, and there are people who wants these kind of contracts, right? So if it is not standardized, there will be no contract. Only if it is standardized, the contract is going to happen. Okay. The question number 7, which of the following is most likely strategy for a UK firm that will be receiving Swiss francs in the future and desires to avoid the exchange rate risk? So they are going to receive Swiss franc in the future, and they want to avoid the exchange rate risk. They are going to purchase a call option. They are going to sell a future contract. They are going to obtain a forward contract to purchase franc for forward, or all of the above are appropriate strategies. If you know the correct answer, let me know the correct answer. You are most likely to receive receive the Swiss franc uh, in the future. So, and desires to avoid the exchange rate risk, what you are gonna do? So the correct answer is you are gonna sell a future contract on the francs. So you are gonna sell a future contract on francs. Okay. So call option would be the opposite thing. Forward, there are obviously risk in the forward contracts. Okay. So you are gonna sell a future contract on francs. Assume that a speculator purchases a put option on British pounds with a strike price of $1.5 for 0.05 per unit. So 0.05 per unit, it is a premium. A pound option represents 31,250 units. So assume that at the time of purchase, spot rate is $1.15 and continually rises to 1.62 at the expiry date. Okay, so why would you buy at 1.62, right? So the highest net profit possible or net loss possible, if you can tell me, just give me the correct answer in that in the super chat. So speculator, he purchases a right to sell. That means he is going to make money if the prices goes down. But instead of that, the prices goes up. The price of British pound, it actually it goes other way. Okay, so instead of getting below 1.5, it went beyond that. So it actually lost the money. So instead of losing this much money, so he's letting go his option premium. So option premium is 0.5 cent. So he's just losing his option premium. He's letting go his option. So otherwise he would be losing 12 cent, but option is just 5 cent. He's letting go that 12 cent. The 1-year forward rate of British pound is quoted at $1.6 and the spot rate for British pound is at 1.63. The forward rate is see, the forward rate is available at discount. It is available at a discount. The 1-year forward rate is 1.6. It is available at discount. You are not expected to know the exact answer. So 1.8, this is not going to be there in your exam. Not exactly very important question. This one is important. Gillon Inc. based in Washington. This is a 2-marker question. Exports products to German firm and will receive payment of 200,000 in 3 months. So you are going to receive 200,000 in 3 months. On June 1, the spot rate of euro was 1.12. On June 1, the spot rate of euro was 1.12 and 3-month forward rate was 1.10. On June 1, the Graylon negotiated a forward contract with a bank to sell 200,000 euros forward in 3 months. So this is the rate he fixed. So he had a forward contract with the bank. He fixed this price no matter what. This is a fixed price. The spot rate of euro is 1.15 on 1 September. It doesn't matter. So the Graylon will receive how much money? So it is 200,000 euros multiplied by 1.10 because that was a forward contract with the bank that was fixed. So $220,000. This is a correct answer. Okay. So that's all, I guess. Somebody's asking collateral and collateral securities. I have done a proper lecture on margin trading, collateral in my course. So just take the course, the SEBI Grade A 2020 course, in which I am providing complete video classes for the concepts based on the latest syllabus
proper test series is there. Notes are available in the downloadable format. 9 final selections we got, and descriptive paper evaluation is there. Join the bank course on bankexamstudy.com. All the links are available in the description. All these students, they cracked the SEBI grade 2018, IBPS RRB GBA 2019, 2020. Result was out in 2020. Bank of Baroda, NABARD grade. I'm really happy for my students. So now it's your turn. You can join the course on bankexamstudy.com. So that's all for today, students. Thank you and have a very, very nice day. Bye-bye.